I'm Monica Gibson. With me down the line for an economic update on the US in light of the latest data feed and ahead of tomorrow's highly anticipated employment change data is Gregory Daco, Chief US Economist from Oxford Economics. Gregory, services sector boom seems to put the US economy back on track, but the market PMI raised warning signals that the GDP growth is unlikely to be maintained. So if the positive can so quickly be outshadowed, does it suggest that really confidence in the US economy is not in fact strong?
I do think that overall the evidence on the U.S. front is quite encouraging. I see the ISM non-manufacturing and the ISM manufacturing, both surveys pointing to strong growth in the U.S. Both readings were the strongest in a number of years. And overall, the evidence in terms of leading indicators for the U.S. economy are quite good, both on the business spending front, but also in terms of expectations of stronger wage growth and also stronger private sector confidence. All those indicators point to GDP growth around 3%, and that's what Oxford Economics is expecting at the end of this year and into 2015.
The surveys indicate that the rate of job creation has waned, as have inflows of new business. Wages have also been cited as a real concern in the US, emphasised with the S&P saying the wealth gap is damaging the economy. Others say a slowing China will be the main drag. But in your opinion, where will the biggest risks emanate from in the coming quarters?
Yeah, I think overall the U.S. economy is quite resilient. I think that the evidence from the job market is quite good with strong payroll numbers, and I see that continuing into the second half of 2014. In terms of the main risks, the main downside risk for the U.S. economy, domestically I see the risk of a more slow recovery in the housing sector being the major risk, and that's tied to slower wage growth. We've been expecting wage growth to strengthen for the past few months, and that is something that would be underpinning stronger consumer spending, but also a stronger housing sector. If that does not materialize, then you're not going to see the acceleration in consumer spending, nor the acceleration or the rebound in housing activity. On the international front, I think China is the elephant in the room. I think that's the biggest risk, not only for the U.S., but also for the world economy. And we could be facing a serious banking crisis or liquidity crisis that's tied into the real estate sector.
The Federal Reserve hinted at an early rate rise should the momentum continue into the latter half of the year, but later said that's unlikely. Are the speed bumps serving to vindicate the Fed's policy decisions, or do you believe rates should be raised sooner rather than later?
I think we still have a fairly dovish Fed, and Janet Yellen is unlikely to lead the Fed to raise rates before the end of 2014. Oxford Economics believes that mid-2015 is the most likely time at which the Fed will start to raise short-term rates. Overall, the Fed is looking at a picture with relatively modest inflationary pressures, with both the core and the core deflators for consumer spending under its 2% target, so that's reassuring the Fed that inflation is not a worry right now. And it's also seeing a high degree of labor market slack. Overall, we're seeing conditions with still some labor market slack, but low inflation, and that should push the Fed to wait until it starts raising rates.
Following yesterday's data feed, the dollar firmed to 9-month highs against the euro. Meanwhile, in Europe, the single currency softened. It really will be a dollar story moving forward. But what is your outlook for this pair, and what will be the main drivers?
I think that the dollar will strengthen vis-a-vis the euro. Two factors are likely to be behind this strengthening of the U.S. dollar. First, we're expecting stronger growth, better growth prospects in the U.S., with growth averaging about 2.1% this year and about 3.2% next year, and growth in Europe, meanwhile, averaging around 1% in the next couple of years. So better growth prospects in the U.S. Should bode well for the U.S. dollar. On top of that, you'll have the Fed most likely tightening before the European Central Bank does, and that will lead to higher rates in the U.S. while rates in Europe remain relatively low. So the combination of better growth prospects and also higher interest rates in the U.S. Should give more weight to the U.S. dollar and help it strengthen vis-a-vis the euro in the coming quarters.
Gregory, thank you so much for your time. Great to speak with you. Viewers, the TV team has plenty more exclusive interviews to come your way, so please do keep clicking back. Goodbye for now.